Finally, let's look at one of the most valuable sections of this financial model, the sensitivity analysis. Now, forecasts are always built using assumptions, but in real world, assumptions rarely remain constant. Revenue growth can be higher or lower than expected. Similarly, production costs may increase due to inflation, supplier pricing, or operational inefficiencies. Instead of relying on a single forecast, decision makers often ask, what happens if our assumptions change? The sheet answers exactly that question. It helps management understand how changes in revenue growth and cost of goods sold affect the company's overall profit. Now, let me first explain how to read this table. Each row represents a different revenue growth assumption, ranging from 5% to 25%. Each column represents a different cost of goods sold, or COGS percentage, ranging from 50% to 65%. Now you see every cell shows a total cumulative profit after tax over the next 3 financial years, based on that specific combination of assumptions. So, rather than looking at just 1 year's profit, we are evaluating the company's profitability over the complete 3-year forecast period. So, why only two variables? You'll notice that only revenue growth and COGS are changing. Everything else, including operational expenses, tax rate, interest, depreciation, capital expenditure, and all the other assumptions remain constant. This allows us to isolate the impact of these two variables and clearly understand how they influence profitability. So, the base case, the highlighted yellow cell represents our base case scenario. So, these highlighted yellow cells represent the base case scenario. So, as you can see, revenue, this kind of assumes the revenue growth of 15% and COGS of 55%. Under these assumptions, the company generates a cumulative profit after tax of 67 crores over 3 years. This serves as a reference point against which all other scenarios can be compared. Now, understanding the Zen green zone, now let's look at the upper performing scenarios. As revenue growth increases and COGS decreases, profitability improves significantly. For example, at 25% revenue growth and 50% COGS, cumulative profit after tax reaches 101 crore. This represents the most profitable scenario in our analysis. The green shading visually highlight these stronger financial outcomes. Now let's understand the red zone. On the other hand, if revenue growth slows while production costs increase, profitability declines. For example, at only 5% revenue growth combined with 65% COGS, cumulative profit after tax falls to just 29 crores. This represents the weakest financial scenario in the model and is highlighted in red. Now moving on to business interpretation. This analysis tells us something very important. Now you see, profitability is influenced by both sales growth and cost control. Increasing revenue certainly improves profit, but if production costs rise at the same time, a significant portion of those additional revenues gets absorbed by higher cost. Similarly, even if the revenue growth is moderate, maintaining efficient production cost can still deliver healthy profitability. In other words, sustainable profit growth depends not only on growing sales, but also on effective managing operating efficiency. So, from a management perspective, this sheet supports several strategic decisions. If the management expects slower market growth, they may focus on reducing manufacturing, costs, or improving operational efficiency. If the raw material prices are expected to rise, leadership can immediately estimate the potential impact on future profitability. Similarly, before approving expansion plans or negotiating supplier contacts, executives can evaluate how different scenarios affect long term financing performance. So instead of making decisions based on assumptions alone, management can compare multiple possible outcomes and prepare appropriate strategies. So, why this matters? So, this type of analysis is widely used in financial planning and analysis, budgeting, strategic planning, and board level presentation. Rather than asking whether a forecast is correct, it answers a much more practical question. If business conditions change, how much will our profitability change? That insight allows leaders to make decisions more informed and data driven. Summarize the sensitivity analysis transforms a single financial forecast into multiple business scenarios. By changing only revenue growth and cost of goods sold while keeping all assumptions constant, we can clearly measure the impact on cumulative profit after tax over 3 years. This helps management understand financial risk, identify the most profitable operating conditions, and make strategic decisions with greater confidence. Overall, it demonstrates that financial forecasting is not just about predicting the future, it's about preparing for different possibilities and making better decisions regardless of how market conditions evolve. So, thank you so much for watching. We will continue the dashboard part in the next video.